Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Hey everybody, welcome to the show. It's Kevin Wadsworth and Patrick Karim, NorthStarBadCharts.com. We're really honoured to have Richard Cormier with us today. You might know him better as Surf City. Surf City Cycles on Twitter, or should I say at Surf City _cycles. Welcome to the show, Richard, and let's hear what you have to say about cycle analysis. I know both Pat and I use a little bit of cycle analysis in our TA, but you're deep diving the techniques here for us today.
Yeah, so thanks, guys. So yeah, cycles are interesting. So I've prepared a little PowerPoint, and then I've got some charts that will illustrate some of the points I want to make about cycles. And I think the most important thing is that cycles are really to be used as a tool to augment your technical analysis. Hopefully you've got a fairly broad set of technical analysis, understanding of chart pattern, things like that. And then cycles can be a great adjunct to help understand financial markets. So let's take a look at what we're talking about.
Don't you want to go to the beach, Kevin, when you see those beautiful waves? I look at that and I'm so happy.
Yeah, so city in southern, yeah, there's a couple different cities have Surf City. One is Huntington Beach, the other is San Clemente, and those two places in Southern California kind of vie for this. So when I learned about cycles, I just kind of threw the Surf City in it because I live about a mile from the ocean.
Nice.
But anyway, cycles, they're basically they're in every facet of our life. You've got season, weather, markets, business cycles. And they're also linked to human emotions is what's fascinating. And, Walter Brissett cycles, and also a fellow named W.D. Gann, believe that cycles, the highs and lows oscillated with investor sentiment or human emotion. So therefore, time becomes an important thing you want to track. And what's interesting is I also use Elliott wave theory in my practice, and Elliott wave theory is largely based on human emotions. And let's look at that. So I think you guys have seen this chart. Many people have seen this chart, right? Emotion. So basically, what you find here is in the depression phase, that's your cycle low, right? Typically, an ICL is when people are, and this is the whole thing. If you're yelling, you should be selling, and if you're crying, you should be buying, right? That's the idea of cycles. But Elliott wave is the same. Where you have an Elliott wave 1 is bullish, Elliott wave 3 is bullish, and Elliott wave 5 is bullish. 2 and 4, waves 2 and 4 are meant to tell you that the bull market's over. They are meant to bring you down into this depression. So they coincide nicely with cycle lows, is what I found. So that's why I use them.
Excuse me, Richard, you said ICL. Are you going to cover?
Yeah,
those,
okay.
those
So yeah, cycles have different lengths. So I'll discuss that on the next.
Okay.
ICL means intermediate cycle low. All cycles within Brissett are measured low to low. So there's different types of cycles. There's 3 that I know of. There's probably more. W.D. Gann, Hurst, and Walter Brissett. Gann was developed in the early 1900s. He was a legendary stock and commodity trader. And what's interesting about Gann, you have to understand, is his methodology uses an echo year. So the echo year is picked where markets are expected to follow some kind of similar fractal. And I don't like that approach because that in and of itself leads to bias. If you've picked a bullish fractal year, you're expecting the market to be bullish. If you pick a bearish fractal year, it's bearish, right? So the number 9 is important in Gann. You can Google Gann number 9 and it'll take you to the Gann square. It's fairly complex. And they also incorporate lunar and planetary influences. So the guy was good. I follow a Gann analyst, by the way. We'll talk about him a little bit later. And he's fabulous on the longer term stuff. Hurst, I don't know much about, but I think it's somewhat similar to Brissett. Brissett is what I use. And it's a time methodology that he developed in the 70s, and his original newsletter was widely circulated and followed by many people on Wall Street. So his approach focuses on longer cycles as they typically dominate the trend of shorter cycles. That's really, really important to understand. Longer cycles dominate shorter cycles. So unless you understand where you are in the longer cycle, you're just spinning your wheels on a daily chart. Okay.
Is that a little bit like saying a very large wave is going to swamp all of the smaller waves on a beach? Is it the same sort of
Yep, exactly.
idea?
Exactly.
Yeah.
And Elliott wave theory, I find, is very useful when I couple it with Brissett. So let's do this is the basics. Price analysis to forecast both cycle length and cycle amplitude. That's what you use it for. It's best, cycle lows can be calibrated with time and price action. Cycle highs, you have to understand where you are in the longer cycle, and then you can do Bollinger Bands and all kinds of things. But cycles will not help you predict a high. It will not. Longer cycles dominate and set the trend of shorter cycles, and longer cycles are measured in years. All cycles are measured low to low, but the longest cycles are at least yearly. Some go very, very long. So let's remember that as I get into my charts. Norms versus rule, we talked about this. Price action around the 10 moving average on the daily, weekly, and monthly charts signals a trend change. That's huge. That's what you need to focus on. And yearly cycles are comprised of what we call intermediate cycles. An intermediate cycle in most assets is 4 to 7 months. On average, maybe 5 to 6 months closer to it, but they can be as short as 4 and they can be as long as 7. So cycle time is not absolute. You've got to look at the price action against the key moving averages. Make sense?
Yeah.
Okay.
Yeah. So far, yeah.
We're gonna jump to some charts right now. Okay. So let's go here, and we're going to start with a couple of charts that I had on. Is there a way to? Can you see this chart?
Yep, we can see that.
Okay, so this is from October 31st, 2022. So this is on Twitter. And this is where I was saying in the November, actually late October, we didn't get the low until sometime in November, but I was saying, based on what I was looking for, was, what I like to do is I like to do horizontal lines now over longer time frames, because that shows me, you look at all these touch points and you got strong support in there. Now you broke here, you broke that pattern, and a lot of people at the time I posted this said, well, Surf, that's not 8 years, that's only 7 years. And they're correct. That is a 7-year, because cycles are not exact in length. So
Yes,
when you
I've measured that 8-year cycle low, and it is, when people talk about the eight-year cycle low, that's really just a way of saying it in a quick way. But in actual scientific fact, when you go back to the 1970s, it's a 7 to 8.5 year cycle low. So
exactly,
you're quite right. It has that variability.
Now, so let's calibrate that. So when they first say, well, that's only year 7, well, then you say, well, where's the year 4 cycle low? Because an 8-year is 2 4-year cycles, right?
Mm-hmm.
So let's go here. We know this is an 8-year low. And by the way, that's 7 years. Because if you go up here, this is year 4 right here. This is your 4-year cycle low. So what you have is a massively bullish top, but then you have a very early top to the next 4-year cycle. So this is 3 years up into a cycle low, 4 years down, 7 years in total into this 8-year low. You see how that works? So and markets love to retest. Here's your retest into a lower high, and now you're starting wave 3 and wave 5 down into that 8-year low, which is actually in year 7. Same thing here. You go up into Elliott wave 1 right here. You chop sideways for several years into a 3-year low. That's actually your 4-year low, and that's Elliott wave 2. See that? Mm-hmm. This is Elliott wave 3 into a cycle high, and then you move it into, this is 4 years from here to here. So this is your 4-year low. This is your next 4-year low at 7 years, but it's an 8-year cycle low because of the price action against the moving averages. Now, at the time, it was a guess. It was an educated guess, but I was speculating that we had an 8-year low forming, and I was right. It was an educated guess. Okay, let's go to the US dollar. It's also on Twitter from the same date, around the same date. And what I had said was, here's your 15-year low, and I believe the 15-year low came early here. Norvas was right, and later I recognized that. So what you have here, here's your Elliott wave 1 high, here's your Elliott wave 2 low, it almost broke this low. Here's your Elliott wave 3, here's your Elliott wave 4, and that's Elliott wave 5. Now, it breached my price channel, but it also hit an important Fibonacci resistance from prior years. If you go back decades, this was a Fibonacci resistance line around 103 that I had. I'm sorry, 113, not 103, 115. 113 to 115 was pretty strong Fibonacci resistance. So those were on Twitter. So then you go, that's let's look at the update. So here's that. Let's take a look at this again. That 15-year chart. This is from this weekend. Now, what I'm saying now here is, if you look at these moving averages, this is where moving average and price action is hugely important. Okay, this is the 100 moving average right here, and this is the 200 moving average, and then this is the 50. So watch the 50. When you're coming out of that 50-year low, you're below the 50 moving average, right? So if US dollar is moving into its next 50-year low, this is not going to hold right here. This is not going to hold. And both of these moving averages will give way, and then there's support here. I don't know if that's going to hold. I would suspect it would. But you're gonna basically, with the price action again on the monthly, look where you found your 15-year low. And you came up here. Now you're coming down, you're finding support. These are not all absolutes. I will change my mind with price action, but right now that's what I'm looking at. So that's the yearly, monthly chart over a 15-year period, right? So let's take a look at the weekly. So now what you've got here is an ICL, an intermediate cycle low at week 19, right? ICLs are 4 to 7 months, 5 to 6 months is a better approximation, but week 19. Then you got another one in week 30, right? Then you got an early top. So early cycle tops, like we saw in gold, lead to market drops. So you got a top in week seconds. You only have enough time. You didn't have enough time to move much lower. So you found a low and a major low. Then you topped early. You retested and crashed. Now you found an ICL in week 25. And you came up and tested the 50 where you were rejected, and or another early top in week 5. You're in week 10 right now. You're in week 10. So again, if you average the dollar's intermediate cycles, average 17 to 24 weeks, guys. Now, I've seen them as short as 14 or 15. You could have a 10-week ICL. It would be extremely rare. I don't know that I've ever seen that one short. It's possible. Anything's possible. But the point is, other cycle analysts would draw a trend line from here to here and say, well, the trend line wasn't broken. So this wasn't an ICL. That's nonsense. The trend lines are subjective. You can draw, many people will draw a trend line, including me, from here to here. So trend lines are objectives. Price action against the 10 moving average is not. Look at this monthly. You're 1, 2, 3, 4, 5, 6 months above the 10 moving average. That is an ICL. If you look at other cycle analysts, they're doubting this is an ICL because this is now the ICL. Maybe they're right. I don't think so. So you got to watch the 10 moving average, and you got to do it on the monthly and weekly. You can't be calibrating ICLs from daily charts. Nonsense. Okay. So that's And now let's take a quick look at the daily, because this will be a lesson learned. So the other cycle rule from Reset is the first daily cycle cannot fail. If you're in a new intermediate cycle, it cannot fail. So again,
because if it does, then you're not in a new cycle. Is that right?
exactly. Then you didn't have an intermediate cycle low.
Yeah. Okay.
So here's my daily count. Here's your ICL. Gold topped on day 17, found DCL1 on day 22. You're below the 10 moving average, right? So somebody didn't spot that as a DCL because they're thinking this is a continuation of a failed implement. But the point is, now you got a top on day 2, and you came all the way down, and you either found a daily cycle low on day 21 or perhaps day 27. What happens when you get down and you're so low, you can pop above the 10. So this is either day 2 or day 7. Now, how will you know which one it is? In my opinion, if it's day 2, it shouldn't make a higher high. Once it makes a higher high than this day 2 high, then it's on day 2. If it doesn't make another higher high than this candle, then it's on day 7. You see what I'm saying? The cycle rule, this is a rule. If this is the cycle low, it can move higher to test the 50 up to the 103, up to this area, right? This would be a B wave. This would be your market retest. Now, if it's day 7, it's already failed. See, it's below this. And this is how you tell a cycle failure. So here's your cycle low. Once you fail, you're moving lower. So if it's failed here, it's moving lower, or it is a new cycle, but the 50 moving average should turn it lower, right? It should not close this Friday or next Friday above 103.15 or wherever the 50 moving average is. So we will know by the end of this week or the end of next week whether the dollar has topped or headed lower. We will know very soon, in my opinion. Okay.
Interesting. It's interesting you set that chart alongside the one for gold, and see how
So
how the story sort of comes together.
Exactly.
Because it's moving a little higher, gold moving a little lower. It kind of starts to fill out a picture, doesn't it?
Yes. So let's look at gold daily to start with, to carry it to talk about your observation there. Now, this is really important, because normally when you move into an ICL, you have a failed daily cycle, right? So here's your ICL that I called on Twitter back in late October. Happened. You go up here, here's DCL1, fairly early top. DCL2 almost failed, came very close to a failure. Now, gold normally has a longer intermediate cycle that's week 22, I think, to 28 weeks, right? Here it is. No, 20. Well, this is, again, daily and weekly, but the point is, it didn't have a third daily cycle. This was an ICL. You were below. I'll show you on the weekly chart why this was an ICL. And so it was 15 weeks. This was also 15 weeks. So all the bears caught that this was a short intermediate cycle. We had 2 back-to-back. So 15 weeks is not even 4 months, right? Just short of 4 months. So that's why I say 4 to 7 months. Now, if you so silver and GDX made a lower low here. I can show you that on our chart. I didn't prepare one. So both silver and GDX failed. So the expectation was your third rate daily cycle is going to roll over and move much lower. And that's what some cycle analysts were forecasting based on what silver and GDX had done. But gold is the cycle driver. Now here's the weekly. Now, again, this shows you better. This is a normal daily cycle at 24 weeks. This is an ICL, intermediate cycle low. So you have an early top in week 3 at the confluence of the 50-week moving average and the 100-week moving average. See that? So this moves you into your bear market low. So you have an early cycle top, 24. You come down here at week 15, Normally, you should have spent another 10 weeks moving lower by cycle theory on time. But that's where you can't ignore price action. Clearly, price is closed back above the 10 moving average on the weekly. You're in a new intermediate cycles. The bears caught this, right? They missed this. They missed the fact that it had a second short ICL at 15 weeks. It spent 1, 2, 3, 4 weeks below the 10 moving average. And now it's made a higher high. So you're in just week 6 now. Other cycle analysts are thinking this is the same intermediate cycle and it's going to fail and roll over soon. Maybe they're right. Again, when I look at the 10 moving average on all time frames, I don't think so. Now here's your yearly uptrend. So now let's look at the monthly. This is that monthly again. And this is the cup and handle we're all looking at. So here's your 8-year cycle low. Wave 1 gets resistance at the 50-month moving average. Wave 2 is below, drops below that 50. Wave 3 top is the previous market high or near it. Here's your wave 4 low. Look at where you are. You're back above the 10 moving average. You found support at the 50-week moving average. That's huge. That's huge. Wave 2 low, wave 4 low, both found support at the 50-week moving average. This is classic monthly cycle action that tells me gold is about to break out. Now, if it closes below this 10-month moving average, I'm going to change my mind, guys. It's possible that it'll be rejected here and go down and do one more of these. I don't think so. But, you know, I'll change my mind based on moving averages. I'm not going to look at daily charts. Now, the other thing I'll show you on this chart, MACD cross. That's a pretty bullish cross. Look at the last, right? This is wave 3 now. See the bullish wave 3? Wave 4, I'm expecting a bullish wave 5. That's how I use Elliott wave with cycles. Makes sense?
Is wave 5 is in wave 3? No.
You know, not typically. In most assets, wave 3 is your most bullish wave. The exception, however, is the gold and Bitcoin, and I stress the word can have bullish wave 5s that are almost as bullish as wave 3. And I stress can. They don't always. You know, you just don't know.
And the wave,
okay,
it's in log or linear, like it will, because it could look. It's the dollar amount. The waves are measured, or are they measured in percentage?
I don't know if this is log or linear. I don't know what the
Doesn't
default
matter.
is. Let me go see. It's probably linear. Let me go see my. I don't change it. It's log scale.
That's log scale because your little squares there are getting smaller towards the top, so that's a log scale.
Yeah, and that's my default. Should I change it to linear?
No, I think with log is more appropriate for precious metals over a longer time scale, I think, because the price moves are logarithmic. They change by orders of magnitude.
Yeah.
But my question was, is the wave 5, do they generate more dollar amounts than a wave 3 in price movement?
Typically not.
Okay.
Typically wave 3 is your most bullish wave. It's a massive impulse move, and you can see it here. So if you go back to that longer time frame, let's look at this gold bull. This shows you right here. So this is your longest time frame chart I have that shows. This is also on Twitter. So your gold 8-year low is your super cycle low, right? Now what's interesting is you measure in time. Elliott wave super cycles can be longer or shorter than an 8-year cycle low. So wave 1, the wave 1 high in 1980 took centuries, right? It took centuries to get to that wave 1 high, right? And now the wave 2 low, it was 20 years. Yeah, the wave 2 the wave 2 low was at 20 years. The wave 3 high, if you look here, took 12 years. This took 12 years. And your wave 4 low took 4 years. Right here, 4 years. So that was less than an 8-year cycle. So again, they're getting shorter, but now wave 3 took, wave 3 took 4 years, wave 4 took 4 years, so this is starting wave 5. But this is starting wave 5, right? And it's taken you this is super cycle. This is less than super cycle. Let me be clear. So this is a super cycle low. Within this first wave up, you've got 1, 2, 3, and then you got an A, B, C into wave 4, and now you're starting you're continuing wave 5 of the super cycle. And where will it top? I don't know, but here's my thinking. Is that when gold found support here, when it got up here and it found support at this level, now you've got a floor at 1,000, right? Potentially. I believe when it breaks out here, your floor for gold for decades will be 2,000. So let's say you get into wave 3. That wave 3 of 5 is about to start, which is going to be uber bullish. Wave 4 could take 20 years, take 10 years. It could take 2 months. We just don't know. Cycles and Elliott wave will not tell you how much time it's going to take. You just have to watch the price action. But you could have at wave 3, you could have it chopping for that could take many years. I believe that 2,000 will be a floor of support. That's my theory using cycles and Elliott wave together.
And
okay.
While you're explaining that, I'm staring at the MACD. It looks just so juicy, all fueled up, ready to go up. It's crazy. Even the RSI looks bonkers, right, Kevin? I had to look at the RSI on the monthly forever, and it just looks it's about to break out.
And people are saying, well, yeah, but there's a divergence on the monthly and weekly RSI. That's laughable. I mean, yeah, there is, because it's consolidated for 3+ years into what's called an Elliott wave expanding flat. This is called an expanding flat. It's a classic Elliott wave consolidation structure. This is an Elliott wave triangle. If you drew a line from here to here and here to here, you can see a triangle. And when you break out from a triangle, as you know, you get a bullish. So the point is, Elliott wave triangle, Elliott wave flat for waves 2 and wave 4. I just everything tells me wave 3 of 5 is about to start. Okay. So that's really let me take one more picture of the gold bull. This is also on Twitter. Look at the monthly volume breakout. Look at that. I mean, there's an old adage, volume before price, right?
That's very true. Yeah, it's worth noting. I mean, everywhere that you look, the evidence is very strong to suggest that we're in the very early stages of a very bullish move for the precious metals. I mean, what you've just shown here with the cycle analysis goes hand in hand with a lot of the other techniques that myself and Pat have been using. I mean, it's fascinating to see how the cycle analysis is kind of hinting at the same thing. I mean, a cup and handle pattern that's taken over a decade to form is sending a strong message, I think, to the markets when we get the confirmed monthly breakout above that dotted line, that blue dotted line you've got on the chart there. That isn't just a small signal that it's sending. That will be a very strong signal hand in hand with what you've just said there about the volume breakout, about the MACD, about the RSI, about the ratio charts of gold to S&P and gold to inflation and gold to the US to DXY, for example. All of these gold to money supply, they're all indicating almost, I suppose might sound a bit dramatic, but like a sort of a tectonic shift from what we've been seeing over the last 3 years, and in fact over the last 10 plus years, a sort of a tectonic shift that is putting us back into a situation that is perhaps comparable with the early 2000s in terms of, you know, the stage that we're at and what we're looking at in front of us.
Yep. Yep. So you remember earlier I mentioned the Gann year of 9?
Yeah.
So what is 2023 minus 9?
That'd be 2014, wouldn't it?
Yeah, and that's an echo year, isn't it? If someone's using that as an echo year to base their Brissett cycles, they're looking back here at a very bearish period for gold.
Richard, just for me and probably a whole bunch of people, what again is an echo year? It's a fractal.
So Gann analysts typically start with an echo year, and they use all kinds of machinations to try to figure out what it was. But I believe if you take 9 is a very important Gann year, as I mentioned. If you just type in Gann 9, and you'll see. So if you take 2023 minus 9, you come up with 2014. If you go to that year, if someone's saying that's my echo year, you're expecting a very bearish period where gold is only going to have bear market rallies.
That surely, as you quite rightly said at the start, introduces automatic bias, because your starting point in 2014 is very, very different from where we are now. In 2014, we were below the key moving averages. We were below a breakdown line there. We topped, having had a very long, strong bull market, and clearly, you know, a topping process had formed in 2011, 12, and very early 2013 that we broke down from. You can draw a horizontal line connecting the lows in 2011, 12, and 13, and a clear breakdown there. So looking at 2014, that is post breakdown. If you look at where we are now, there's no way you can describe it as post breakdown. We are, in fact, on the cusp of a breakout, an upside breakout.
Absolutely. So that's, at least that's my view. So when you look at this, again, just look at the 50-month moving average. So your Elliott wave, your bear market low, your 8-year low, and your super cycle 2 low, gold is below the 50-month moving average. You come up here, and in the wave 4 low, it's below the 50-month moving average. Look at where gold found support here at that 8-year low, right at the 50-month moving average. Hugely bullish.
The 8-year low, I meant to ask this earlier on, but I didn't want to interrupt you. And it's a point that I think is worth discussing, because I think we both agree that these cyclical lows in reality occur roughly every 7 to 8 point, well, actually every 7 to 8.5 years, and you can summarize it as the 8-year low. But anyway, so the question being, was the low in late last year the major 7 to 8.5 year cycle low? And we sort of fell $400 there from 2000 down to 1600 in broad terms. I just wonder if we get a strong move up to, let's say, $2,500, or maybe even a little bit more by some estimates, whether late next year, or in sort of Q3, Q4 next year, whether we might actually still see a drop of that size, or even more. You know, could we potentially go to $2,500 or more, and then come back down to 2000? You know, I suppose what I'm saying is, you know, what is your confidence level that the 8-year cycle low is in, and that we're not going to see a multi sort of hundred, you know, a drop of several $100 at some stage next year?
Okay, let's look at, we're going to go back to the daily.
And I asked that because, you know, that when you think about the 2008 low or the 2000 low, you know, after they were put in, we didn't see a significant sizable pullback for a number of years. So if the 8-year cycle low was at the back end of last year, then we should be powering upwards for a number of years.
Okay, so let's I don't know about a number of years when gold,
well,
gets,
unless the cycle is very left translated, I suppose.
Yeah. So no, but here's what I would say. Is that my expectations are that we're going to something's going to happen happen either this week or next week to confirm my analysis, right? The dollar's got to move lower and gold's got to start moving higher. That's going to be wave 3, which is a bullish wave. Now, what my expectation is that's going to move up, and then you're going to move down into probably an ICL, right? And that'll be wave 4. Now, that could be 1 ICL, it could be 2 ICL, it could be multiple years again. I don't know. But I do expect 2000 will be tested again to make sure it's a floor. And then that final push higher of that 5 of 5 wave will take you above whatever wave 3 is. I'm expecting wave 3 to top, could be wrong, later this year. Let's say the fall of 2023, sometime maybe October, November. Then you're going to move into a yearly cycle low, right? And it could be an ABC correction. It could take a lot of time. I just don't know. But I'm expecting gold to break out into the fall of 2023. And that's where it will form a wave 3 of 5 high, of the final wave 5. That's my current forecast. We'll see if I'm right. What's important, your question, if gold moves below this 1816, that's a failed daily cycle. So if in the next several weeks or months you move below this, then you're going to be a fairly early top, because you're only in week 6. And even if you're going to be, that means if you have another short 15-week cycle, you got 10 weeks down. This is the daily, but I'll show you the weekly. So let's look at the weekly. Same thing. This is huge. This 18, I don't know if it's 1816, 1812. You can't break that now. You got to hold that. While gold makes a new high. So my theory is gold makes a new all-time high. It's not a bear market rally, right? But it's got to make that all-time high before it breaks this level. And it shouldn't, if it makes a new all-time high, I'm thinking 2000 becomes support. That's my thinking.
And another piece of evidence, of course, is that gold is at all-time highs in British pounds, euros, Canadian,
Exactly.
Australian dollars, Japanese yen, you name your currency. So when gold breaks out in every major global currency, except the US dollar follows. It just doesn't happen that it breaks out to all-time highs in every major global currency except the dollar, and then everything comes crashing down. That's not something that history has proven to be something that's likely to happen.
Yeah.
How do you define the bear market rally? Like, a lot of people have different ways of measuring that, a back test of a descending trend line. Like, how do you define that? What constitutes a bear market rally?
Great question. Let's take a look at gold monthly. So it's kind of disguised here, but look at the RSI pattern into this top. That's a bear market rally.
So you're looking at declining momentum.
Yeah. So that's what Elliott Wave calls a B wave. So here's your A, B, C into wave 4. So this was a slightly lower high, but the RSI was warning you that it was a B wave.
All right.
Is it? I mean, can you say, to sort of make it simple, is it true to say that a bear market rally, you can continue to call it a bear market rally as long as you don't make a new higher high?
You know, that's not actually true, because Elliott wave B waves can make slightly higher highs. Right. It's rare, but you do see them. Right. But it's typically with very, very weak movement on the oscillator. I mean, look at the MACD. Look at the oscillators on the monthly. This was a retest, right? Yeah. And right now, quite frankly, you have a retest. So in theory, you could collapse here and maybe go down into an 8-year low. So I'm subject to changing my mind, right? But this low right here has to hold at 1820 or 1816 or whatever it was. You can't break that before you make all-time highs.
It's also interesting that the 3-year moving average, the 36-month moving average, which, looking at previous gold bull markets, has contained the price throughout the entire sort of bull market. 2008 came down to test the 3-year moving average, but didn't break it. And the 3-year moving average is sitting currently around just about in that ballpark area. I think it's 1825. So that kind of confirms what you just said as well, or it's not, it doesn't confirm it, but it's another piece of evidence that you know that is important. You don't get in a healthy bull market, you do not get price breaking down below that sort of level.
That's right. That's right. So I'm looking for, you know, I don't know where gold may not even close below 2000 on this daily cycle low. It's below currently on the daily. Gold is below the 10 day moving average, and my expectation is that it will close below 2000 maybe for the last time in a long time, but it shouldn't. It should find support around, if I go to the daily, chart, one would expect, like it's here's this was from today, I believe. Yeah, the 17th. No, it was yesterday. But it broke below the 10 and it's testing the 20, right? Yesterday. Today it's back testing the 10 from below. If you look at it, it's going up and trying, and I think it's failing. So typically you go back and test the 10 moving average to see if you can get back above it, and then you drop down. And that's why I'm thinking you're going to see somewhere between 1980 and maybe 1920 is your cycle low, is what I'm thinking.
Yeah, and that's on your uptrend support line as well, isn't it, pretty much?
Yeah, and then you know, you look at Fibonacci and things like that. So and I typically find these support areas through horizontal stuff on you know, but and Fibonacci, but the Fibonacci tells you with gold bullish, it typically is going to hold the 62% retrace.
Yeah.
Right. So that's the story on gold and the US dollar. And then I've got some charts, some weekly and monthly charts on Bitcoin, crude, and the SPX if you want to discuss those.
Yeah, so what are your thoughts on crypto? Because I know a lot of people have gotten very bullish on cryptocurrencies. Clearly bounced off an important support level there. Is that the 4-year cycle low? As I can see from your chart there, it looks like.
I believe it is. I really believe it is, because the pattern of Bitcoin is to make a top in year 3, and it's not going to hold. This pattern is going to change at some point, but it makes a top in year 3, and then it retraces 80% of its gain in year 4. So this was. It doesn't show when you do a Fibonacci, the 62 is somewhere up in here, but the this is an 83% retrace from this low. This is a 70%, 77% retrace. So it didn't quite get to 80. But now look at your back, you're either 2 or 3 months above the 10 moving average, and you're testing the 20. Right? That's the 20. And I have resistance now at about 34 to 36, 35, right? So I'm thinking this intermediate cycle, if this is the 4-year low, and I really believe it is, you're going to come up, you're going to test this resistance, you're going to come down and test 20. 20 should be support now again. 20 should, this is where 20 people wanted to see 20 hold as the floor. Didn't quite, but it's back above the 20K. And it needs to get above here long term. Otherwise, you could see an A, you know, you could see this is an A, B, C correction, right? You could. Would that break the bear market? I don't know. I'd have to do more analysis. But right now, that's the monthly, right? And then if you look at the daily or the weekly, here's your weekly. And here again, this is how I find horizontal resistance. I look at the Fibonacci first, which I don't show on my charts because it kind of clutters things up. And then I say, okay, if that's the Fibonacci, is there, and then I draw this box based on Fibonacci resistance. That's how I do that. And other candles. So that's where I'm seeing resistance. It's also near the 100 week moving average. And right now it's testing the 150 week moving average. it's having trouble getting above it. But I believe my thinking is we're going to come up here and we're going to see an IC high, and then you're going to come back and test 20,000, and then you're off to the races. Now, Bitcoin, what's interesting is Bitcoin's cycles are much longer, the daily cycle. Its intermediate cycle is also around 4 to 7 months, but its daily cycle is typically 56 to 66 days on length versus gold of, say, 23 to 29 days. So every asset has a different, bonds are short, US dollars are short, SPX is longer, crude is longer, Bitcoin is the longest daily cycle that I've found. So you have to understand the timing bands of each asset. Intermediate cycles are somewhat common. They're all around 4 to 7 months, 5 months, 6 months, somewhere in there. But daily cycles have varying lengths. And so until you understand those lengths, you can't develop timing bands.
Interesting to see. I guess, well, I would expect NASDAQ to have a very similar cycle length in that case, because Bitcoin and NASDAQ seem highly correlated in the analysis that I've done. So I would expect NASDAQ to have a very similar cycle length to Bitcoin. It'd be interesting to.
Have you ever compared Bitcoin to gold?
Yes, I did a tweet recently on that.
They're almost inverse to some extent, aren't they?
Yes, yes. You want to show my on my Twitter? I put one. Gold. If gold breaks out, Bitcoin hibernates. Once gold puts in a peak and starts breaking down, that's when Bitcoin breaks out.
And vice versa.
Yes. Because
So
the thing is, we haven't seen Bitcoin in a true secular bull market for gold, right? So because Bitcoin's inception was early, like when the U.S. equities were breaking out versus gold, but now U.S. equities are about to break down versus gold. We haven't seen that relationship. So we've only seen gold's bear market rally within the SPX. So when gold broke out in June of 2019, Bitcoin flat and even corrected 70% to those March lows, while gold was just rocketing to its all-time highs in 2020. Once gold put in that top, then Bitcoin broke out in August or July or whatever of 2020, and it did its move while gold went nowhere.
Yeah. But you can see here Bitcoin cycles are about that 4 to 6 months, 5 to 6 months, right? So here's another DCL that was around day 60, and now you're moving higher again. So here's the thing is, this is a rhetorical question. Is Bitcoin a security or is it a currency?
Definitely not a currency.
That's a very long
yeah, let's not get into it.
It's an easy answer, Kevin. It's an easy answer. It looks just like the meta chart. It looks just like Shopify. It looks like all these NASDAQ stocks. It looks exactly like that. For me,
until it behaves different to a NASDAQ stock, then
it looks just like a meta chart, overly meta chart on Bitcoin. If they track to perfection, they corrected 77%. They rebounded. Even Meta outperformed the Bitcoin on the rebound. It went up 130% off the bottom. It's practically the same chart. So it's definitely like whatever classification you want to put on it, the regulation type of label, it's tracking the tech stocks. I
mean, Bitcoin, when you stop and think about it, Bitcoin is traded in exactly the same way as stocks and shares. Currencies, I venture to say that not many people have an app on their phone so that they can buy and sell currencies in the way that they do with cryptocurrencies and stocks. So it's acting more as a trading investment than it is as a currency. Currency is falling 80% in 12 months. Well, if it is a currency, it's not a very good currency. If you can go up and down.
Yeah, I would agree. It's not a store of value. It's a very speculative investment. But here's what I would tell you. It would seem to me the pattern I've seen over a decade at least is that only Bitcoin or gold can battle the US dollar at a time. When gold is surging against the US dollar, as Patrick mentioned, Bitcoin's in hibernation and vice versa.
Mm-hmm.
So
you could say the same for Meta. Only Meta or gold can battle versus the US dollar. You could do that argument.
Yeah.
So I'm gonna jump. We'll go back to crude and SPX, but I'm gonna jump to let me see if I want to do that. Let's look at the other currencies, and then we'll come to gold's. Gold has a longer cycle. It actually has a 40-year cycle. Okay. And most people don't know about this. I discovered this through a GAN analyst named Eric Haddock. You can find him on the internet. He's got a 40-year cycle page. Here it is right here. You see this? This is Eric Haddock. And he believes there is and this is his free stuff. He has a subscription, and I just mine his free stuff. But he believes gold has a 40-year cycle. Now, 8 divided into 40 is, so it's really 5 8-year cycles, right? So I'm going to go to the next slide. And I'm going to start from current slide. Eric Haddock believes there is a 40-year cycle of what he calls hard money versus soft money, gold versus imposters. Mm-hmm. And he dates this back to, if you look at the 1816 to 1821 period, that was after the War of 1812, and the U.S. went to a deep economic slump. So that's when they created a second attempt at a central bank during this period. All right. Then, Henry Jackson President Jackson takes us off the gold cycle somewhere in the 1840s, and you have a panic of 1856 to 1861. And that was a global panic. And it was really a panic when you dig into it and you do the research about gold versus fiat paper currency, right? And there was a lot of speculation with railroads and stuff in the United States, but it was a crash before the Civil War. Then you got 1896 to 1901, where gold standard wins out over silver. I don't know if you remember the silver. There was a thing in the United States where they were trying to make silver a part of gold, or be the silver standard, and basically that ended on 1850s. On this 96 to 2001, the gold standard became the predominant standard, and silver took a second back seat. Then you fast forward 40 years. And FDR confiscates gold. And I know you didn't become Bretton Woods until 1944, 47, or whatever it was, but that was essentially the gold. The US dollar ascended to reserve currency, right? Then he talks about 76 to 81, after Nixon took us off the gold standard. The Jamaica Accords formally ended Bretton Woods, right? That was 76 to 81. That was your gold wave 1 bull market high. And you go 40 years, 2016 to 21, that's where you had the brush out of the bear phase, the bear market low, the wave 4 low, into wave 3 high. And that was, that established 1,000 as a floor. So that's where I'm thinking, if we break out above 2,000, that becomes the new floor. So we're starting a new 40-year cycle, is the way Eric Haddock. These are 21 ends the cycle, and then a new 40-year cycle begins. So if you're starting a new 40-year cycle and gold is bullish, all these attempts were pretty much attempts by fiat currency to suppress gold. Are we entering a new era where gold is going to take the lead? It's just, you guys might want to look at his site, mine his site. He's got some interesting stuff. But I actually contacted him through the contact, and I asked him, I said, what echo year do you use for your forecasts? And he had an interesting response. He said, I don't use echo years, I use echo periods. So he's typically looking at the echo period of the mid 70s to the 80s.
So he's using that echo period for the coming
for now
years.
For his forecasts now.
Yeah.
Well, no, for his forecasts from 2016 to 2021, they were spot on that gold had a massive, but he also is an Elliott wave guy, and he's saying that gold has several Elliott wave people I follow say that Elliott wave developed an expanding flat into wave 4 and is now starting wave 5. He's one of them. So he uses GAN to look at previous periods where history rhymes, but he doesn't focus on a year. He focuses on a period, and then he uses Elliott wave to calibrate where the price is moving next.
I'll tell you another element to this. You talk about 40-year cycles. The US 10-year yield peaked around about 1980, having risen all the way through the 1970s. The 10-year yield and interest rates rose steadily through the 1970s, peaking around about 1980. And then we've had 40 years of downtrending 10-year yields, which have been capped and contained below a very clearly defined trend line. And of course, after 40 years, the trend line broke to the upside, and now the 10-year yield is above that 40-year declining trend line. So there's your 40-year cycle represented by 10-year yields as well.
Is it 40 or 60?
40, 1980 to 2020, roughly, isn't it?
But it's low to low, Kevin, right? The cycles, right? From what I understand.
Yeah, low to low. Yes, right. From a cycle point of view, yes. But from the point of view of a 40-year trend, I was thinking more.
Yeah, but I think if you look at, supposedly there's a 60-year interest rate cycle that goes back to the time of Hammurabi, which was 3,000 years before Christ.
Yes.
Wow.
So supposedly, I think our who's the guy? Martin Anderson talks about that from time to time. So that's, I've got a couple more things, but I want to save those for last. Let's take a look at crude. So we talked about Bitcoin. I'm cautiously bullish on Bitcoin. It's got to prove itself, but my sense is if gold's in a bull run into this fall, then Bitcoin's going to meander, have bullish periods and bearish periods. But if gold's wave 3 of 5 tops, that's when Bitcoin will take off. And that's fine because Bitcoin's still early in its 4-year cycle, right? So as gold moves into its wave 4 after its wave 3 top, that's when I'm expecting Bitcoin to surge based on that. Again, you got to be careful with interrelationships because they don't always hold. So here's crude. Once again, you've got to close. I think we found a major 3-year cycle low here from the COVID. If you go COVID here, or where, no, this doesn't show COVID on the chart, but it's 3 years from the COVID low. But you got to close above the 10-month moving average. Otherwise, you're going to move lower. So this month is going to be crucial. If you can close above this, now you may come back down and get above it next month. But the point is, until you're above on a monthly basis that 10-month moving average, you haven't confirmed a 3-year low. Make sense?
Because one question I haven't asked actually, why 10 months? Is it just wonder where that comes from? Because a lot of it's 12 months and 3 years.
So the 10 moving average on all time frames. 10 moving average on the daily signals a trend change, 10 moving average on the weekly signals a trend change, 10 moving average on the monthly signals a monthly trend change, longer cycles. So it's the 10 moving average on any time frame, monthly, weekly, or daily, that signals a trend change.
And that's just because that particular time period has proven to be the most
it's cited in Brissett's work.
Okay, right. Okay, that's
right. That's I take it as the Bible because I mean here's the weekly, here's the 10. See the 10 guides price up, you break below it, now you're back above it.
Yeah. You
break below it, that signals a cycle low. Now you're moving into your next weekly cycle.
Yeah.
So it's on all time frames. And that's why I watch the longer charts. I watch monthly and weekly charts to confirm what's happening on the daily. I only look at dailies to confirm when I'm expecting a weekly cycle top, then I start looking at dailies. Right? But why waste? I mean, you'll find some people on Twitter citing, an ICL using a daily chart, and that's nonsense. You can't calibrate an ICL with a daily chart. It's just bad practice, in my opinion. So here's your come on. Here's your crude weekly. So now it's an ICL because you're above the 10 on the weekly, but you don't know if it's a 3-year cycle low because you're below the 10 on the monthly. But it's an ICL. 20 weeks, 24 weeks, 25 weeks. See that?
Yep.
Okay.
And that RSI is hidden, but it looks like it's about to break out from the median line.
Yes. So this could
actually
be a major low. And if this is your wave 4 low, then oil's going to new highs, new all-time highs, which would mean inflation. Which would mean inflation is coming back, right?
Well,
Right now,
that is an interesting point, because a lot of the charts are also, I believe, suggesting inflation isn't finished with us, and we've got another wave.
Especially in the U.S., if the U.S. dollar is topped, U.S. citizens are going to face inflation. So the thing that you'd probably want to do is buy resource stocks in Canada and Australia that have good dividends.
Yes.
Yeah.
Because you're going to get price appreciation and nice dividends.
I noticed some of the commodity indices are breaking out, like the CRB index, for example. So
yeah, so you're going to have you should have an epic commodity bull run here, but you're also going to have epic inflation, which is the bad news, right?
You need to choose an asset that's outpacing inflation.
Yeah. So here's your, this is trying to be objective. If you can't get above the 50-week moving average, this is your B wave resistance. If you can't close above that, you can get above it, but if you don't close above it on a weekly basis, then you're likely headed down to a C wave. So this would be A, B, C. That's how that would work. So I'm pretty convinced this is going to break out, but I gotta see the price action, right? And it's in time. This is time for it to move in. It's about time to move into a daily cycle low. So you could see it come back testing. You often see a test of the 10 moving average as your wave 2 before you break higher. That's typically what I see. You test resistance, and then you come back and test the 10 for support. This is what happened here. So you come up here. You never even test the 10 on the monthly. You tested it here, but that was moving into a low. You went high. You did a market retest into a high, lower high. Now you close below it. Anyway, so that's gold. I'm sorry, crude weekly. But again, the weekly is starting to turn higher. So I expect a little bit of a run here. Now let's look at the SPX. Here's your XPS monthly. This is a chart that's warning that you may have a major cycle top, and you may be moving into a 10-year or so bear market. Not confirmed, confirmed in any way, but you've got a massive convergence on the monthly RSI, right? But not confirmed with the MACD, so it's not confirmed. Now you've got, this is your 4-year cycle low. This is your 4-year cycle low, almost perfect. And you had a very bullish top in year 4. Well, now you had an early cycle top in year 2 of your 4-year. Did you just make a yearly cycle, a short yearly cycle low in week 30? Boy, that's pretty short. But there was a 30-week ICL after the 2008 crash. If you look at the charts, the first ICL out of that crash, oftentimes assets, when they want to get going, they'll have a short ICL. So I'm not telling you that it's absolutely headed lower, but I'm telling you this is B wave resistance right here. 44 to 4,500, somewhere in there would be a retest of the highs. And then, but this dotted line is where the normal 4-year cycle low would take place, right?
Richard, that red dotted line, how did you draw it? What was your reasoning for putting it there?
So several things. I did Fibonacci, and that was up around the 68 or 62%. And then I drew a line and I said, look at all the touch points. So when I draw horizontal lines, look at the touch point, and it didn't, that's support. If this breaks down, it'll probably hit here, bounce, and then maybe go lower, maybe go all the way down to here. But these are your support levels based on touch points. That's the way I use it.
The more times the line is tested, then the more.
Yeah, and analysts, exactly. Analysts use them a lot on slanted lines, cycle analysts. I've started using horizontal lines because I found them to be, when you use them in conjunction with a Fibonacci number, pretty balls on, and a key moving average. It can be, so right here, between this line and this line, you've got the 100-week moving average, right?
Kevin, I'm going to tell you something about this moving average thing. And Richard, you can tell me if I understood. Often when I use moving averages, I fine tune them to exactly where I see previous bounces, not penetrations, bounces. And I said, that's a meaningful support. But by using a moving average, Kevin, that's a little tighter. He's actually he wants to see it penetrated. And then he could use that as ICL, saying it's, or I forget the terminology, but the fact that it gets destroyed, then you're in territory where it could be a low getting put in because you've exaggerated the movement to the downside.
Yes.
Something like that, right?
Yeah, and so it's a calibration of when you move below the 10 moving average, you look for on a weekly, you're looking for an ICL. So this is the monthly. Let's look at the weekly. So here's the weekly.
He starts looking for the ICL once he's below the moving average.
Yep. So, but look at this action. Here's your below the 10 all this time. You keep coming up and testing it. You keep going lower, and it's not surprising because you topped in week 9, and you bottomed in week. No, I'm sorry. This is crude. I got the wrong. Sorry. Let's look at the SPX. So this is your XPX daily or weekly. So here you have a top in week 3. After your ICL, you're below the 10. See how you're below the 10? Now you top in week 3, and you come all the way down here into your ICL. So that's an ICL. Is it a 4-year cycle low? Too early to tell. I don't think so. It's 2 years. That's really, really short. It could happen. Again, you got to remain objective. You got to look at the price action, but look at the resistance you have here. This is Fibonacci resistant. These are near the 50 and 62. I think, I don't know exactly because I don't have the Fibonacci, but I put that up first, and then I draw my lines, and then I get rid of the Fibonacci. That makes sense. But you're testing initial resistance of the previous cycle high here, and you're also wedging. See that this is a classic Elliott wave consolidation pattern that you can break higher or lower out of. See that? So you've moved lower into this ICL. This is a more bullish intermediate cycle than this was, obviously. But you're still, this is daily. This is not a bullish looking cycle to me. It's a consolidation. If it breaks out, then you might get up into this B wave territory. And then that would be A, B, C, which is where you go back to the monthly. A and C waves are typically similar in length and amplitude. So if you look at SPX monthly, this is your A wave, this is your B wave, your C wave is going to take you down in this territory.
Yes.
You see how that works?
Yeah. It's so weird because you don't seem to get trapped, and people always trying they try to play the bounces, but the way you do it is you want to make sure you're in the clear and you have the tailwinds instead of headwinds, right? Because now you see that people, they're trying to play that bounce, but there's a lot of headwinds on top, and it's not clear yet, right? It's not time going at all.
No, or if you're long, you're not leveraged long.
Yes,
right?
You're playing just.
You don't want to be putting any leverage into this market, is my opinion. You could have long positions and you know where to get out. So basically, do a daily. But I think if I look at the weekly, I think this is your last CL, and you got to so they're high. So if it breaks this line, you're going down, right? If it breaks this line first, you broke this. This is once you failed daily cycle, you're typically once you have a failed daily cycle, your longer intermediate cycle is topped. Does that make sense?
Yes.
So you have a failed daily cycle. That's why I look at the daily. If you have a failed daily cycle, now you know you're heading into an ICL, and you want to typically get out with your profits, or you do it sooner based on other methodologies. But that's basically this is a questionable market. I'm not gonna I'm not shorting it because a B wave territory move would be painful to short, but I'm cautiously watching it. I'm long with some stocks, but I don't have any leverage.
Right. I call that just being in like in no man's land. People always think they need to be long or short, but sometimes the market, you just got to let it do its thing and wait until it's really giving you the.
Yeah, it's about confidence, isn't it? It's confidence levels, and there are times when you're trying to forecast the future of anything where your confidence level can be pretty high. It's never 100%, but you can have high confidence. And then there are times in the markets, or as I say, forecasting the outcome of any future event where your confidence level is low, and your confidence level is low when the probabilities of a range of possible outcomes are all quite similar. If you've got three different possible outcomes, up, down, and sideways, and the probabilities of those are all fairly similar, then your confidence is low. But once you start getting confirmation, your confidence levels go up, and that's when you can take advantage of being aware of what the technical analysis is telling you by but going in more heavily on the upside or the downside.
Yeah, great point. So the way I really pay attention to moving averages and price action against the moving average, because that's the price component of cycles, right? Yeah. Time is one element, but you can see I've shown you countless short cycles and even long cycles. So you can't just, so that's basically it. It's just time, and the key short-term trend is the 10 moving average. That's the one you want to follow on all. When you know you're above the 10 moving average or in a time frame where you close below, that's a signal probably to get out and take some profits. Now, is that profit on a daily, weekly, or monthly? I'm more on the weekly time frame, and less, but the daily comes important when a weekly cycle tops. So I'm mostly a trader. I try to find an ICL and ride it for 3 to 5 months. That's my trade window, right?
You're surfing the bigger waves and the ripples are
yes, I'm not trying to. When I had my service, a lot of people wanted to trade the dailies, so I was forced to do that. If I ever got another service again, I'd say, if you want the dailies, go find another analyst. I'm just not going to focus on those a lot. I don't know that I'll ever get back to, and I'm enjoying retirement too much.
Anything on daily time frames can be quite stressful, I have to say. I've looked at that kind of trading, and it doesn't fit my trading investment style. I probably a bit like you prefer to catch the higher confidence, bigger waves, which are more reliable and more you can have that confidence level. The smaller ripples that come along within those bigger waves, they tend to be far less. I don't know how you can, they tend to just be swamped sometimes by the bigger forces.
Yep. So guys, I got couple more slides for you on the PowerPoint. Have you noticed that violence is picking up all over the world?
It's a bit hard not to, isn't it? Yeah.
Yeah. Yeah. So I got something for you on that. This same guy, Eric Haddock, believes that solar cycles, sunspot cycles, impact both markets, and human emotion, as well as the Earth's core. So sunspots have an intriguing 21 to 22-year cycle. They're actually 11 years. So 22-year cycle is an 11-year cycle. So the sunspots, if you look at a graph, it's 11 years. But the major amplitude peak is at the 22-year, 21 to 22-year. So this one is pretty crazy. Apparently, it's supposed to be one of the strongest on record. Okay, so what Eric Haddock says is that if you look at that 22-year pattern, you'll see major earthquakes, major volcanic eruptions, and major wars. So I haven't done the real deep dive. He's posted some stuff about what happens with earthquakes and everything else, and volcanic eruptions. But here's his 22-year cycle for war. You go to 1917, and and this goes back centuries apparently in the Western world. You got 1917. You got World War I. Go fast forward 21, 22 years, and World War II breaks out. You got the Holocaust. 22 years, 22 years, you got 59 Vietnam. Then you go another 20, you got 1980, where Soviet invaded Afghanistan, and you had that huge Iran-Iraq war. 20 years later, you got 9/11. 20 years later, where Ukraine breaks out. And he's thinking that's just the start. Many people saying the United States is going to go to war with Russia. The United States and NATO are already in a proxy war with Russia. We're maybe China's next. I don't know, but something happens, he believes, that impacts human emotions, that creates us more a more violent nature. And you're seeing it in all the political rhetoric. You're seeing it in the United States talks about a civil war. You're seeing it in Ukraine, but the violence is just incredible. Look at the school shootings in the United States. So I think he's onto something. And so the thing is here, you may have a gold bull market, you may have the dollar crashing, but it's also time to be careful with your friends and family and hunker down, because if this gets nasty, the violence and wars into 2025 or 6, I believe, could get nasty.
Yeah, well, I think that there clearly is a lot of danger in the world at the moment, and there's a lot of conflict, and there's a lot of conflict of ideologies between East and West, and between competing financial systems. The dollar as its reserve currency status and all that kind of stuff feeds into this. So you get the feeling that there are tectonic shifts taking place, in a lot of markets and in a lot of aspects of the world around us. So yeah.
So what I would say is that's kind of my view and kind of a primer on cycles. And that's really what I have for you today. Maybe after this, we can chat a little bit after the recording stops, unless you guys have any more questions.
Well, I just want to say, from myself and Pat, we really appreciate that, because I know a lot of our listeners and watchers, really want to learn about psychoanalysis, and they're aware of psychoanalysis, and some are skeptical, some, kind of dismiss it out of hand. But to those people, I would just say simply, what you said right at the start, that human life is a cycle. The seasons are a cycle. Everything around us takes place in a cyclical nature, in a cyclical fashion. So human psychology, given that human psychology is affected by the seasons and follows these same swings to the upside and the downside, then it makes perfect sense that everything that we touch also, creates these cycles. Our psychology, the way we behave in financial markets, is naturally going to cause peaks and troughs and peaks and troughs in these markets. So identifying them, analyzing them, and knowing how to interpret them is something that really every analyst should try to have as part of their kind of arsenal of tools to help in the trading, in profiting and making sure that you're not on the wrong side of the trade and entering trades at precisely the wrong point.
Yep. Yeah, I think they're useful. You just have to be careful. The key things I would tell everybody is watch the 10 moving average on multiple time frames for a trend change around your timing bands. And then secondly, respect price action. Price action trumps time.
That's right.
The cycles can be long or short, and what will tell you that is price action. If you ignore price action and you focus on time solely, you're not using them properly.
Right.
No, because price is the ultimate purveyor of the truth, isn't it? So
that's right.
As long as you might want to deny what price is doing, it's like me as a meteorologist putting out a weather forecast and being outside and seeing that the weather's doing the exact opposite of what I predicted and just refusing to change my forecast. Well, that's not going to work, is it? It's a sunny day. It's a sunny day. It doesn't matter if I forecast a cloudy day. You're wrong. So the facts have to take precedent over any prediction that you might put out there. And as soon as the facts start to run against your prediction, then you need to adjust your prediction. It's not a case of being wrong. It's a case of accepting that the new facts and the new evidence are plotting a new path.
Correct.
Yes. When I hear Max Kaiser he was interviewed by Daniela Camboni, and says, Don't worry about the price, Daniela. The price for Bitcoin will fix itself. The thesis is good. It's limited supply. That breaks my heart when I hear that. It's like, what are you talking about? The price would fix itself? The price has to follow his thesis. No, it doesn't. Or maybe if it does, it could take years and it might not even be his thesis moving the price. Years later, he'll realize that was something else driving the price action. So it's just like, just look at the price. That's the only thing where we could hit buy and sell and actually appreciate our net asset value is actually by pressing buy and sell on price charts. Like I can't press buy and sell on a thesis. Like the thesis could be wrong for 10 years. What am I going to do? Explain to my wife, I lost 70% for 10 years and I'm dollar cost averaging. What was that about? It's like, anyways, it's just.
So one last thing, guys, that in addition to timing highs and lows, I would say that cycles help you set stops. Because if you follow that daily chart and you know that you're late in an intermediate cycle and you're starting to head down, you close below the 10, what I'll do late in that intermediate cycle is I'll take 50% of my profits, right? And then if I get a failed daily cycle, then I know to maybe look to, that might be an ICL if it's in my timing band, that's where I might add those back. But the point is, you can set a stop at the previous daily cycle low, and if you drop below that, that's your signal to get out. Otherwise, you ride it up late in the intermediate cycle, and you get out when you get a swing high or some other signal for you. But respecting price, to your point, Patrick, you always leave some chips on the table because you might be in an Elliott wave 3 where your cycle lows are very muted, right? And you're not going to retrace much and you're going to blast off again. So Elliott wave 3 impulse moves, boy, if you're in an Elliott wave 3 and you recognize you're in an Elliott wave 3, you just ride that puppy.
That sounds like a great place to wind up the interview because, as you say, ride that to the peak, and that's exactly what.
Okay. Can we chat a little bit when we're done here after you stop recording?
We'll carry on talking, but for everybody watching this, thank you for watching and listening. I think everything that you've heard from Surf there has been an absolute masterclass in cycle analysis. What do you think, Pat?
Yeah, what a showcase. I learned a lot there. So I appreciate your time to explain all that. And I know some of our members, they were asking more about cycles. So might as well bring in an expert and tell us all what it's about, man. Really appreciate your time, Richard.
Yeah, thank you very much, Richard.